Hello and welcome to the discussion on financial accounting. We'll continue with the session on preparation of financial statements from a given set of business decisions. In this case, once again, we have a set of business decisions. We'd like to convert them into financial statements. So started business with capital. So capital is a receipt and capital is a source. You availed loan of 75,000, so it is a receipt and the loan is a liability and a source. Purchase goods for cash, so purchase is an acquisition of stock and inventory will appear on the balance sheet. So acquisition of stock has resulted in outflow of cash. Purchase of stock on credit, so acquisition of stock has resulted in creation of a liability, so the stock will increase to the extent of 20,000, so there is an inventory of 70,000 and 70,000 has been created because of the payment, reduction in the cash and creation of liability. Purchase a plant on credit from X, so plant is 30,000 and X is a supplier and creation of a liability. Acquisition of an asset resulted in creation of a liability. Purchase of shares for cash, the shares is an asset of 30,000 and that resulted in the payment. So payment has resulted in the creation of an asset. An asset here is the share. Rent paid for the period. Before that, sold 60% of the stock for cash. So 150,000 is the sales and entire sales is for cash. The corresponding cost of goods sold is 60% of the inventory, that is 42,000. So this inventory reduces to the extent of COGS. Rent paid, rent is an expense and rent is a payment. So an outflow of cash resulted in an expense. Salary is an expense and salary has been paid. So the entire salary has been paid. No asset, no liability with respect to the expenses. Interest for the period, 10% of interest, so 0.10 on the loan, and let us assume that you paid the interest, so interests have been fully paid. Dividend received during the year, dividend is an income, an entire dividend has been received, so the dividend is a receipt and an income. So this total income is 165,000, total expenses is 199,000, profit is negative 34,500 and we transfer the negative profit also to the balance sheet. The cash in hand is a cash available 290 minus cash payments 237, so cash in hand is 52,500. Cash in hand is 52,500. So in this case, unlike the previous one, there is a negative profit. We transfer the negative profit to the balance sheet. In the process, we can see that the company's equity has come down. Equity of the company is capital plus retained profit. So the equity is 15,500. The liabilities are the rest of the other items are the liabilities. In this case is a loan, creditors and X. Now we make a small change here. Here we have made the salary of 100,000 and the profit is minus 34,000. We'll change this profit as a salary, and salary, let us make that as 120,000 and all other things remaining constant. The negative profit goes up to minus 54,000. So the retained profit is minus 54,000 As a result, we can see that equity has become negative. So the negative equity is minus 4,500. In this case, equity has come down. The equity is 15,400, which is capital minus the retained profit. So the retained profit or the losses, negative profits are less than the capital. So still you have a positive equity. Whereas in this case, the negative profit is more than the capital, so the equity has become negative. In fact, a company with a negative equity can be called a sick company. Equity can be positive, equity can be negative, equity can be zero if the negative profit is equal to the capital. Thank you very much.